let's set the stage a little
All
bit.
right, all right.
This is an actual client of mine, 25 years old, just graduated college, and he's looking to start his secure compound interest account. And the question that he posed to me was, "Hey, I do have some debt, and he would feel more comfortable if he was able to get rid of that debt first before he starts his secure compound interest account." I have my own position on whether or not he should eliminate the debt or not, but it wasn't for me to say. He asked for my help, and I said, you know what? Absolutely. I can walk you through some of the things that we've used, some of the opportunities you have available to you to be able to eliminate this debt pretty quickly. Short of it, though, is I would have much rather him just jump right in and get his secure compound interest account started, because that can also be used as a vehicle to eliminate debt. All he has to do is get started. But regardless, I know there's a lot of people just like my client who would feel much better about their situation if they were in a better financial position before they started something like this. So I get
M-
that as well. But again,
Man,
25 years old, fresh out of college, about $10,000 in debt, and we'll jump into it. He's got a credit card. He's got a couple credit cards actually that have a total of about $2,500 due on those credit cards, and he's got a small student loan that he has left over from when he graduated of about 1,500, and he's got a car loan. As far as specific debt that can be addressed, that's pretty much it's about $10,000. But that's not all of his numbers, right? As it relates to velocity banking, the best way or the way you achieve success through velocity banking is you have to know your numbers. So in this case, what do I mean? After taxes, he brings home about $3,000 a month. His expenses total of about $1,900 a month. And the cash flow is a spread. And the reason it's a spread is because some months he pays more in gas. Some months he has the grocery shopping between him and his roommates, and then some months he pays less. So there's a spread of around $300. Again, he's got a car worth about $6,000. There's about 6,000 owed on the car, and I don't remember the interest rate that he's paying on the vehicle, but I know it's a 36-month loan. I don't know if you can see it yet, but $3,600 times three is 10,800. So for a $6,000 vehicle, he's paying $10,800 if he was to wait 3 years to pay this vehicle off. So at a minimum, doing velocity banking so he does not have to go to term on this car makes sense. He's got about $2,500 in credit cards. And again, as I mentioned, we're going to use one of those credit cards to use as our debt tool. And he's got that student loan of about 1,500 bucks. And he's paying about $800 a month in rent is his portion. His other expenses, and I'll break down what those other expenses are, but those other expenses, and we're talking, gas, electric, stuff like that, is about $400 a month. He's got a car note, credit cards. He's paying about $250 a month in total. And again, student loan, it's 10% on the credit cards and it's 10% on that student loan. So it's about $150 a month is what he's paying. So in total, we're talking $1,900 monthly is what's coming out as expenses. And then those other expenses, here's the cool part about the other expenses as well. The other expenses, the cable, phone, and electric, this $400 a month. We've already determined that every bill in his other expenses can be paid by credit card. And here's why I bring this up. A lot of the clients that I work with, when I say, hey, you can use a credit card as a debt tool, one of the first questions that is that, hey, but what about my rent? What about my mortgage? What about those bills that can't be paid by credit card? There's a few different ways to address this. One, you can be a bit strategic, and all bills can absolutely be paid by credit card if you're a bit strategic about it. Meaning, if you use your checking account a little bit differently and use a credit card as with overdraft protection, you can use a credit card to pay those bills that traditionally wouldn't be able to be paid. But in this example, what I decided to do is not even address it. It's just a fact. Some bills can be paid by credit card, some bills can't. So we're going to split the approach to velocity banking here and pay those bills that can be paid by credit card, and those bills that can't, we won't. And you'll see that we're still able to tackle this debt pretty consistently, pretty effectively, and it doesn't take very long. And then lastly, cash flow. As I mentioned, he makes about $3,000 a month. We've already established he's got about 1,900 in expenses, and so his cash flow is about 1,100. Again, that's just simple math. But again, this is a range. Sometimes it's 900, sometimes it's 1,300. But it's a range. On average, it's about $1,100 a month in cash flow. And there are many different tools that can be used for velocity banking? Well, again, he's 25, fresh out of college. He doesn't own a home, so a HELOC is out, and he doesn't have a strong credit history, so a personal line of credit is out. Although by the time we're done, he'll easily be able to qualify for a personal line of credit. But as of right now, he does not. And as most people who graduate college, he's leaving college with credit card debt. The easiest place to get a credit card at this age is in college. And so he is walking out of college with 4 credit cards. So we're going to take one of those credit cards and use the credit card as the debt tool.
Some people will say you can't pay everything with a credit card. That's not true. You can pay everything with a credit card. It just depends on what credit cards you have or what bank,
Right.
who you're banking with. So I just wanted to just clarify that.
It is not as difficult as you might think. The key is most banks just need you to have a better relationship with them. Meaning, if you're trying to use a Capital One credit card on your Chase account to pay a bill, it's going to be kind of difficult. But if you have a Chase credit card with a Chase checking account, there are ways that you can link those two to be able to address all bills coming through Chase.
And can you
Is it-
imagine if you're paying your mortgage, the points and the free stuff that you will get from that card? Whoo.
Absolutely.
Yeah, okay. I'll send you back.
Kind of the recap before we even get started. His before situation is he's got about $1,900 in bills that he needs to address. We're going to use one of these credit cards as a debt tool. When we address that credit card, we're immediately going to eliminate the debt on this credit card and therefore use it as a tool. And once we do that, his cash flow is going to increase from the $120 that he was paying on that credit card to now that $120 is going to be sitting on his debt tool as cash flow. So the minute we introduce this debt tool, we're going to immediately increase in cash flow. And then we're going to address these other areas over time. By the time we're done, we would have eliminated all of the debt with the exception of those items that just have to continue to be paid, like rent and those other expenses like his cell phone, gas, electric, etc. But everything else will be eliminated. We will get rid of the student loan. We will get rid of the car. We will get rid of all the remaining credit cards. And it'll happen pretty efficiently. So as I mentioned, he's got 4 credit cards. He's paying about $2,500 in total is the balance due. And again, it's 10% on credit cards. So he's paying about $250 a month. We're going to pull out the credit card with the largest balance. And I'm doing this intentionally. The credit card that we're using happens to be a Bank of America Cash Rewards credit card that allows him to get 3% back. All of the others are pretty basic. They're pretty basic student cards that he had gotten early on. And in addition, the credit limits are lower. So we're going to take the credit card with the highest balance, the highest credit limit, and the one that gives him the most amount of perks. 3% cash back is pretty awesome. And so we're going to isolate that credit card and use it as the debt tool. Again, to quickly go back through the process of velocity banking. Once he gets paid, it goes into a checking account. We're going to immediately move that money from the checking account onto the debt tool. And from the debt tool, we got to pay bills. So from the debt tool, we're going to pay bills. And then once we pay bills, that cash flow ends up living on the debt tool for the duration. So let's jump into month 1. So again, he makes about $3,000 a month. So that $3,000 a month in income is going to go into his checking account. And from his checking account, we're going to split this dollar amount. We're going to split a portion of the dollars is going to go towards those bills that can be paid by credit card. So we're only going to put on the credit card the amount that we can actually pay from it. So the reason we chose $1,600 is for 2 reasons. One, this debt tool, this credit card has a balance of $1,200. So this $1,600 on this, putting $1,600 on this debt tool will immediately wipe out this $1,200, which means this $120 a month is gone. Once I put $1,600 on this credit card, $1,200 is gone. It's going to leave me a credit of $400. Throughout the month, he still has to pay his other expenses. And if you remember, the other expenses bucket can all be paid by credit card. So throughout that month, he's going to pay the remaining $400 of the other expenses from this credit card. So In total, he's putting $1,600 onto this debt tool, which will eliminate the balance on the debt tool, and he's going to pay the other expenses from this debt tool. But what's left over from his income? Well, if you put $1,600 on the debt tool, it leaves $1,400 that's sitting in his checking account. Those bills that he cannot pay by credit card or cannot pay from the debt tool would include the rent. You can actually pay the student loan, but I left it out here anyway just because I can. But $800 in rent, $150 in student loans, car loan, and the $130 for the remaining credit cards. Again, we're just going to continue paying the minimum from his regular checking account. So we're making a chunk of $1,600 onto the debt tool. $1,200 of that wipes out the credit card, and the remaining $400 wipes out the other expenses. Well, once he pays bills from his checking account, he put in $1,400 into his checking account. $1,380 was paid in bills. There's a remainder of $20. So for my emergency fund people, he only has $20 left in his checking account. That may seem as though he's out of cash, but he's got a debt tool. This credit card has a limit of $3,000. That $1,100 in cash flow has now moved. Instead of the $1,100 living here, that $1,100 is living here plus some, which means if there's an emergency, if he has a flat, if he has to get his car fixed, if he has to catch a flight, he has $3,000 available on his debt tool to be able to take care of any emergencies. This $20 won't do much, but any money sitting in his checking account isn't helping him anyway. So I just want to make sure that's clear. So in essence, $1,400 goes in, $1,380 pays bills. We address these bills. We've addressed these bills. And once we address the other expenses and the $1,200 on the debt tool, the remaining balance on that credit card is zero. So now we head into month 2. In month 2, we do it all again. In month 2, he's got $3,000 coming in. We're going to split a certain dollar amount onto the debt tool. Well, what should that debt be? We are now going to address these credit cards. And well, I guess I can do it this way. We are now going to address these credit cards. Because if you remember the credit cards, there was a total of $130 a month that was being paid. Well, instead of paying this $130 a month, meaning paying the bare minimum, we're going to go ahead and address the entire balance. We're going to address the entire balance of $1,300 for the remaining amount of credit cards that we have. And so how do we do that? Well, we're going to take $1,700 out of our income, put it onto the debt tool. Why $1,700? Remember, we've got the other expenses of $400 that has to be paid and a total of $1,300 in credit cards that have to be addressed. So $1,300 plus $400, total of $1,700 that's going to be paid onto the debt tool. Once I do that, that wipes out this debt at this point. And the $400 in expenses is an ongoing expense, so it doesn't change that. But notice, once we do that, when we put $1,700 onto this debt tool and then pay these expenses from this debt tool, I'm showing a balance left. I'm showing a balance of $39 being left on the debt tool. Where does that come from? Again, just high level talking through it. $1,700 goes onto the debt tool. $400 is paid on other expenses. The remaining $1,300 wipes out the remaining credit cards, but I'm still showing, instead of a zero balance, $39. Where does that come from? Well, in order to pay a credit card with a credit card, well, first off, you can't. You can't walk up to Discover and pay Capital One. They just won't allow you to do that. But if you remember, for most of us who have credit cards, you get these little checks in the mail. There's these little checks that say, hey, for 18 months, 0%, you can do a balance transfer. Or for 12 months, 0%, you can do a balance transfer. After that 12 months, your interest rate will jump up to whatever that dollar amount on the remaining balance. Well, using those little checks, and they are literal checks, using those little checks, we would do a balance transfer of this full $1,300. So we write a balance transfer check for $1,300 to pay off this entire amount. But when we do that, The credit card company that we used that check on won't allow us to do that for free. In the fine print, it talks about a balance transfer fee. That balance transfer fee can be anywhere from I've never seen it really above 3%, but my assumption is it can be higher than that. So somewhere between 1% and 5%, I'd say. Most of the ones I see on average are right around 3%. So if we're going to do a balance transfer of $1,300, we've got to pay for it. So that $1,300 is going to cost us 3%. Well, 3% of $1,300 is $39. So this $39 left over is coming from this balance transfer, meaning once this $1,300 is paid, once this $1,300 from these credit cards are transferred over to the debt tool, it's going to cost us $39 to do so. All right, so that carries over into the next month as well. So again, $1,700 in, $1,700 out. I'm left with $39 left over on that debt tool.
Which is the balance transfer fee.
Which is the balance transfer fee. Okay. But a couple things have happened. A couple things have happened in the span of 2 months. In the span of 2 months, we've gotten rid of all of the debt on the debt tool, meaning that $1,200 is gone. In addition, we just paid off an additional $1,300 on the remaining credit cards. So that $10,000 of debt that my client came to me with at month 0, we've eliminated, what's that, $2,500 in debt in 2 months. The only way we were able to do that, though, is because he decided that he wanted to learn how to use a dollar multiple times. Otherwise, what do most people do? They spread the payments out, meaning maybe 500 would have went to one, 500 would have went to another. You're still accumulating interest over time, which makes it feel as though you really didn't make a dent into that debt. But because he focused on one debt immediately, it immediately went away because he had enough cash flow to be able to do so. And then from there, he was able to tackle the second half of his credit card bills. So now it's time to go after the student loan. So it's $1,500. We're paying about $150 a month. So to address that again, it's more of the same. This is not complicated. We're doing the exact same process that we did the previous 2 months. Your income comes in. Here, I used the laser. Your income comes in. We're going to split that income between $2 amounts, right? So how much goes on the debt tool? Well, I've got my normal $400 in expenses. I've got that $39 that was sitting on this debt tool, at the start of the month. And now I'm going to address the student loan. But notice, the student loan was originally $1,500. And I was paying 10% every month. So $1,500, 10% every month is $150 a month. Why am I only paying $1,300 to pay it off? Well, you have to remember what month we're in. We're in month 3. And I apologize for my handwriting. We're in month 3. But what happened in months 2 and month 1? So in month 2, we paid $150. And in month 2. And then in month 1, we paid $150. So we've already addressed a portion of this $1,500 in month 1 and month 2 by paying the minimums. And those minimums were $150. So $150 in month 1, $150 in month 2, that's $300. So if I, you know what? That's an error. So that is $300, and $300 being addressed in month 1 and month 2, that number isn't even $1,300. It's actually less than that.
Okay. Look.
Go ahead.
We're just going to go with it.
Yeah, it is. It is what it is because the math still works out. The math is still the math. The math is still the math.
I will get with her and I will let her know to make sure the math is good next time.
It is all right. Moral of the story is we've already addressed the payments in month 1 and month 2. Month 3's payment is less. And so, which is why this number is less than the original balance. And so we put $1,639 onto the debt tool. Then from the debt tool, we actually pay our $400 in other expenses, the $39 on from the balance transfer, and that $1,300 on that student loan, which means we zero out that credit card once it's done. So at the end of month 3, we've addressed 3 debts. At the end of month 3, we've addressed our debt tool, we've addressed the remaining credit cards, and we've addressed the student loan. The only debt we have left is the car loan. And now we also have to look at the car loan the same way we looked at the student loan. Meaning, in month 1, we paid $300. In month 2, we paid $300. And in month 3, we did the same. So that $900 in payment has already been addressed on a portion of that $6,000 that we owe, which means there's $5,100 left that we owe on this vehicle. So now it's time to pay off this vehicle. So how do we do that? Well, $5,100 is a lot. His balance, his limit on his credit card is $3,000. We never want to max out our debt tool. Why? Because the debt tool is where our cash flow lives. The debt tool is where any emergency is going to take place. So even though he only owes $5,100 on the car, we don't want to put him in a position to where he's now maxed out that credit card and he doesn't have room to address any issues that might come about. So therefore, if you look at the previous years, he comfortably was putting in $1,200, somewhere between $1,100 and $1,300 a month onto the debt tool. So why not just continue down that path? Meaning, if he was to do another chunk of about a little bit over $1,600, $1,636 to be exact, and I'll explain why it's $1,636. But you put $1,600 onto the debt tool, that remaining $1,364 is what goes into the checking account. That $1,636 is covering what? Obviously $400 of expenses. There's a $36 amount sitting. There's a $36 amount on from a balance transfer fee that needs to be addressed, and then we're going to chunk $1,200 towards that car loan. We're actually making 2 payments towards the car loan. We're going to chunk $1,200 to address the balance faster, and we're going to make our normal minimum monthly payment of $300. So in essence, we're putting in $1,500 as opposed to just $1,200. And as I mentioned on the debt tool, there's still a balance left. Well, where does that balance come from? It's the same as before. When we were doing a balance transfer on the credit cards, there was a fee associated with it, right? Well, this is no different. I'm going to take one of those same checks and do a balance transfer of the $1,200 that we've been chunking and address this car. And remember, in month 1, month 2, and month 3, there were payments. There were payments totaling $900, which means instead of $6,000, it's actually $5,100 due. So if I make a chunk of $1,200 from that $5,100 leaves us at about $3.9K. But don't forget, in addition to that, there's a $300 a month payment that's going to be addressed as well. So there's a $1,200 payment going in plus a $300 a month payment. And that $1,200, I'm going to pay a 3% balance transfer fee on that dollar amount totaling $36. So what does that look like? $1,600 goes in, $1,600 is coming out, again, addressing the $400 in expenses plus the $1,200 in for the chunk on the car. But because of that balance transfer, there's a total of $36 left on the debt tool for that month. And so in month 5, we're going to do it all again. $3,000 goes in. We're going to chunk the same dollar amount. So $1,666 goes on to the debt tool. The remaining $1,364 goes towards our normal bills. $1,200 is going to go towards the car loan. There's that $36 from the debt, from the lingering $36 on the debt tool from the prior month. And we're going to address the $400 in regular expenses. The $1,100, again, we only have 2 bills left now. We've got rent and we've got that car loan. So we're going to make, again, double payment. $1,200 chunk plus $300 for that car loan going on to the car just to pay it off faster. We're in month 5. And So now in month 5, again, what does that look like? Because we've that $3,600 is being addressed by the $1,200 that we've put in, leaving about $2,400 left on the vehicle that we owe. But in addition, there's $300 being paid on this vehicle. So again, $1,500 in total is what's coming off that 2.4. And we do owe another $36 based off the 3% transfer fee going into month 6. So again, 1,600 goes in, 1,600 comes out, leaving 3,600 on the debt tool because of that balance transfer fee. And then we head into month 6 and we do it all again. 3,000 goes in, 1,636 goes on to the debt tool. We are getting pretty close to having this vehicle paid off though. So in month 6, 1636 goes in onto the debt tool. Again, we have $36 left over on because of that balance transfer fee. But what does that look like? Again, sound like a broken record, right? $2,100 was a balance that was owed. We put $1,200 on it. We left with $900. But also, in addition, there's $300 that's also going to be added to this dollar amount, which means instead of $900 owed on this vehicle, it's only $6. And then we also have to address that $36. Again, 1,600 going in, 1,600 going out, $36 being left on the debt tool, and we address it. Month 7, something special happens. In month 7, instead of the normal $1,600 that needs to go into the debt tool, it's only $1,018. Why is that? Well, there's only $600 left on this car loan. So we're going to pay our other expenses. 600 plus 400 is 1,000. And we're going to owe a balance transfer fee on this 600. That's where this $18 comes from. And because we have now addressed the car loan, there's no car loan here. So the only bill left coming out of our checking account is the rent. And notice, over these last 7 months, we've accumulated a fair amount inside of our checking account. It started with $20. Then it jumped to 50. But notice it just kept getting bigger by 264. And then at the end of the month, at the end of the month 7, that 1982 that went into checking, because there was only $800 needed to go towards rent, that left 1182 as cash flow for that month. So again, in walking through the vehicle, that $1,600, $600 is what's owed. We pay $600 from the debt tool, which means that now the car is now paid off in the span of 7 months. What was a 36-month loan has been paid off in 7 months. How much interest was saved because we paid off this loan in a 7-month span? What happened to his credit score paying this vehicle off? Like there's so much working here. And the $600 that we chunked to pay off the vehicle, we do still have to pay 3% on that balance transfer, which equates to $18. That's where that $18 comes from.
But how many people would say, oh, there's a balance transfer? No, not going to do it.
Well, and we'll address that later as well, because this is a small number. I would say to address what was potentially a $10,800 bill, meaning if he would have let that car go for the full 36 months, to turn a $10,800 bill and dwindle it down to being paid off in a span of 7 months, I would say that $18, that $36 a month is worth it. But put a 0 on the end of those numbers, meaning what if that instead of it being a $6,000 bill, it was a $60,000 bill? And you taking a balance transfer of 3% based off instead of $18, $180, or instead of $36, it's $360. Those do get there's an argument to be made that balance transfers aren't the best. In this situation though, because they're small, I can make that argument all day long. So again, $1,000 goes in, $1,000 goes out. We're left with $18 on that debt tool, but the car is paid off. So what have we done in the span of 7 months? We've addressed all of his $10,000 worry. He has 0 debt left after 7 months. And it's all off using. He didn't make any additional money. He didn't borrow money from anywhere else. There was no influx of cash all of a sudden injected into his process. All he did was restructure how money comes in and how money comes out. Before, all of his money was going from his checking. I'm sorry, coming into his checking and going out from his checking, paying bills. And he was struggling keeping up. That debt was starting to creep up on him. Those high interest rates on those credit cards was starting to pull him down. All he did was restructure things such that now he's using one of those cards as a tool to address debt faster. That was the only change here. And as I mentioned, his debt tool was a Bank of America 3%. I think it's called Bank of America Rewards 3% cash back. So every month, because he was using 1,600 in month one, 1,700 in month two, 1,636, and so on. Because of those dollar amounts being paid from the debt tool, he was getting a certain amount of cash back as well. So every month that cash back continued to grow. It ended up being right around $321 over that 7-month period. How much cash back would he have gotten back inside of his checking account had he just continued doing things the way he was already doing them? Maybe 1%. And I'm hearing a lot about a high yield savings account. Let's say he was getting 3% back. Like, that's awesome, but was he addressing the debt at the same time? Like, there's multiple things happening here, and it's all because of structure. It's all because he used the debt tool to be able to address his debt in a different fashion. So just a couple things to note. Balance transfer fees. During this example, I kind of explained them as though not that big of a deal, but it would be easy for balance transfer fees to get out of hand. And in this situation, this guy, 25 years old, fairly efficient in being able to address his debt. So doing a balance transfer of $36, $39, $18, not that big of a deal. You add a zero to any of this debt. I don't know that it mathematically makes sense to take a $360, $390, $500 balance transfer fee to address debt. And again, I can argue both ways. So the easiest thing to do would be in month one, when he addressed that first credit card, and then in month two, he addressed the remaining 3 credit cards. He should have immediately applied for a personal line of credit then. Why? He's improved his debt to income ratio, improved his credit utilization, and now he's in a much credit worthy position to be able to walk into a bank. The debt tool that we use was intentionally using the credit card that was tied to his checking account. Bank of America has clear visibility into the performance that he's had with this debt tool, which means when he goes to them and asks for a personal line of credit, what could they possibly tell him? Like, look at the actions that he's taken over these last 2 months to be able to eliminate debt. And they have full visibility into how that happened. So his ability to walk into Bank of America to ask for a personal line of credit, there's a high likelihood that he would be approved. And it doesn't even matter what that dollar amount is. Let's say it's a $3,000 personal line of credit. That $3,000 personal line of credit compared to a $3,000 limit credit card, there's a huge difference there. A personal line of credit is an open-ended vehicle. So with a personal line of credit, you can get all of your income in, get all of your income out at any point, and there's no balance transfer fees in doing so. So you're not charged an additional dollar amount for using it. And then in addition, that personal line of credit can be used for anything. It has a banking and route, it has a bank account number and a routing number, which means every bill can be paid from that personal line of credit. You don't have to now segregate your funds and pay some from the debt tool and some from your checking account. Having a personal line of credit gives you the capability of now paying every debt from that personal line of credit or that debt tool. And then a huge one is payment dates. I don't talk a lot about this. This is actually my first time talking about this on air, but I talk a lot about this with my clients. When you pay your debt matters. So if you have a credit card, there's a statement date that you're going to receive on that credit card statement, and there's going to be a due date. Most of us pay bills based off the due date. When what we should be doing is be paying those bills from the statement date. Because what it does is, if we go back through this velocity banking example, paying off that, putting all of your income onto the debt tool and then paying the bills from the debt tool, paying off that credit card prior to the statement date, it doesn't register. Meaning you've had this debt sitting on this credit card for 30 days. Paying off that debt before the statement date, it doesn't register to the bank that there was any debt even on that credit card. So in the worst case scenario, it might show $18. It might show $36. It might show whatever that balance transfer amount was. But from the bank's perspective, when you pull up the statement, it shows no expenses registering because you've been paying off this bill by the statement date as opposed to the due date. And then the last piece is what to pay first. Any I'll call it velocity banking gurus out there that may watch this might criticize me for one using a credit card and paying off other credit cards first, or saving the student loan for last as opposed to the car loan, because when you pay debt matters as well. Some debt doesn't hurt you as bad. For instance, credit card debt being variable and high interest is probably the worst. But there's a debt that's even worse than that, and that is amortized interest. Amortized interest is front loaded. So I would say that one is one that you would want to tackle first, but because he didn't own a home, there was no point in kind of bringing that up. But simple interest compared to variable interest compared to amortized interest matters. And when you address that debt also matters. So the order of how you do velocity banking should be taken into consideration. I think in this example, it was pretty cut and dry. Because he had decent cash flow, it really didn't matter which order we went in because it still would have been all paid off in 7 months anyway. But when I'm working with clients who I'll call it are in a much different credit position, we definitely want to identify what order of debt we address and how that interest is laid out. Is it simple? Is it variable? Or is it amortized?